My name is Erin Lemond. I am one of the business partners in ELJ Athletic Shoes. This project has been done by my co-owners, Landon Nealon and John Farmer. Our strategic vision is to continue to be a responsible citizen and partner with the communities, continue to use local and responsible suppliers for our material, increase awareness to our company through community services to provide the best and safest working conditions for our best assets, which would be our employees. Our 2-year projections vary based on the topic. Our earnings per share, we continue to have a high earnings per share score and have always met investor expectations. We have been best in the industry for 5 years throughout year 11 through year 20. We project that throughout the next 2 years, our earnings per share will continue to grow upwards of 16%. We will remain exceeding expectations of our investors. Return on equity. Our return on equity has unfortunately fluctuated throughout year 11 through year 20. We have only met investor expectations 3 years out of the 10 that were surveyed. Our 2-year projection is that for our return of equity continue to fluctuate around the 19 to 20% mark. Our credit rating has stayed high through year 11 through year 20. We continue to meet investor expectations as we have for 8 years. The last few years we have maintained an A+ credit rating and project this to continue throughout the next 2 years, which exceeds our investor expectations. Our image rating has continued to increase throughout year 15 and beyond. We have met investor expectations 5 years and have been in the industry for 4 years. Have been best in the industry for 4 years. We hope to continue this pattern and remain in the 92 to 97 range. Our stock price target has been on a steady incline throughout year 17 through year 20. We have met investor expectations and were rated best in the industry 4 times. We expect this pattern to continue in the 320 to 350 range. Our internet market has never been our strongest point of net revenue. However, our internet sales continue to increase over the span of the above years, ranging from 90,315 to 319,337. In the future, we hope to improve our internet sales with proper advertising. As you can see, our internet sales varied. They started off at 90,315. They dropped down in year 11, went back up in year 12. Year 13, we continue to see a rise. Year 14 was a very big gap between 97,459 sales to 134,199. After that, boosted to 170,000, and then almost doubled to 230,000. Upwards from there, 255,000 to 296,000 to eventually 319,000. We have seen a huge growth in our internet market. It's not necessarily where we want it to be. We would like higher sales, but it is on the incline. Our wholesale net revenue has always been our biggest net revenue. It ranges anywhere from 314,731,000 to almost triple that to 921,193,000 in year 19. We understand this is a vast difference, and we do hope to see this trend continue in the future. If you take a look at our numbers here, we've had a steady incline over the years. Our wholesale started at 314,731,000. Year 11, we hopped up quite a little bit. It is 335,877,000. Year 12, again another increase to 399,524,000. And then we hop it back down quite a little bit in year 13. We went to 393,155,000. In year 14, went right back up to almost where we were in year 12. 399,963,000. Year 15 was probably our biggest year starting or since the beginning, I guess since year 10, we were up to 519,965,000. That was a big year for us. And the incline continued into year 16 for 572,562. Year 17, we saw another huge increase, almost $100,000 to 692,030. Year 18, again, another huge increase, 890,403. And then our biggest increase was in year 19, and that was at 921,193. So as you can see, a steady incline, and we do hope to see these trends continue in the future, hopefully well into the millions.
So the competitive strategy, with Company C, we really wanted to focus on a high price strategy, increasing price until we reached a certain break point throughout the whole entire year plan. Lower price, increased market share was kind of an objective we wanted to do. We really focused, as you'll see later on North America and Europe, Africa markets to really target with our shoes. In the graph below, you'll notice it kind of has a layout of our overall plan. We initially, our offer price started out a consistent 32 and began testing it out as the years went on to a little higher, came to an average of about 40, noticing that that was a right price for us. Our SQ rating was a standard, usually stayed right around the same ballpark throughout all the years. Pairs offered increased as the years went on, and we had a little bit of a hiccup through year 12, 13, and 16. Those were tough years for us when it came to really getting out to the market and not enough pairs sold. Our market share percentage in the beginning initially began to increase very quickly, again hitting that hiccup through year 13, 14, getting that back up to where we wanted it in year 15, and then hitting a point at year 16 to take us down a little bit, and then finishing the rest of the 3 years strong. So for our production strategy, we really wanted to focus on low resources and expand our plant capacity. The use of overtime we kind of played around with throughout the years. We really wanted to focus on good training for all the employees and a competitive workforce compensation. In the graph right below, you'll notice our 4 different regions, heavily really focused on the North America and Asia Pacific regions. Initially, we really wanted to test those out, especially North America, putting out some really good numbers of productivity for both. As the years went on, productivity began to increase, and about middle way around year 14 for all 4 regions, we were heavily impacted with the production strategy and really focusing on expanding from there. If you look to the right, we kind of have a layout of the 4 different regions also, with our average compared to other companies in the database, and our average for North America was definitely higher than the other regions. We really focused on our total regular compensation, and kind of as you go down, you'll see the changes in the percentages. Our finance strategy, we really wanted to do a high credit rating throughout the entire year plan, paid off our dividends, and have a steady financial plan throughout the entire process. If you look below with our profitability measures, our gross profit margin compared to all the others was a little bit above average, and our operating profit margins was a little bit above average compared to everybody else. With our dividends data, our dividends per share was $1.75, and we had a higher amount of dividends in return to get a lower average percentage of payout of net profits. Our credit rating measures were consistent compared to everybody else, right around the same average, a little bit higher than usual, and our risk of default was lower. Our current ratio was right around 24.14, which was right around the average number compared to everybody else. And we really focused on our days of inventory till 19 days. Competition in the internet market. Above me is the graph with kind of the layout of our internet segment. Our main competitors would definitely be company A, B, D, and E, all having a similar retail price. Free shipping we did not partake in. Competitor A, company A was definitely the only one that partaked in that. Our SQ rating percentage was right around our top competitors. The thing that set us aside was our celebrity appeal. It was definitely higher than every other company and kind of gave us an advantage when it came to online. Our brand reputation was also second highest out of all the other companies, which helped put us atop. Online orders was right around kind of average with everybody else, and our pairs sold was exactly equal to our online orders. Our market share percentage was right around the average throughout all the other companies. Competition in the wholesale market. Below is a layout of the different companies and the different wholesale segments. Our wholesale price was just around higher than mostly all the other companies, with our SQ rating being at the same kind of level as our internet market. Brand advertising, we spent less than anyone out of all the other companies. In return, had a rebate offered a little higher than most. Retail outlets, we had a large number of retail outlets and a large number of retailer support. Celebrity appeal was also higher than anyone else, and our brand reputation stayed consistent. Our pairs demanded and our gained and lost was the best out of all the other companies, getting the most pairs sold out of our return. Our biggest competitors through this phase was definitely company A and company D, returning a good investment and a good amount of pairs sold, with all three of us having a very high market share percentage. Competition in the private label market. Again, above me is kind of the same kind of layout with our private label segment. Our offer price was higher than most at 40.25. SQ rating was a little bit lower than the internet market and the wholesale market. Our pairs offered and our pairs sold was the highest amount out of any other company in the segment, and our market share percentage was substantially higher than everyone else's at 57.3%.
The total revenues for our shoe company started out in year 11 at $42,646, and at the end of year 20 we wound up at $1,821,215, with only 2 dips in it with our steady incline. Those 2 years we failed to sell any of the private label shoes, which hurt our numbers. Our earnings per share started out at $257 at year 11 and did a steady incline with only 1 dip to $16.51 by year 20. Our stock had the same type of effect. We started out at $33.34, and after 2 months where we did not sell any shoes for the private label, we wound up in year 20 with a stock price of $297.69 a share. Our high during the time was $340.86 at year 18. Continuing with financial performance, the next one I'm going to talk about is our image rating. At year 11, our image rating started out at 67, and at the end of year 20 wound up at 93. Our high was at year 17 at 97. For our credit ratings, we wound up with 4 A pluses, years 17 through 20, and with some A's, and a couple of B pluses moved in, so our average was actually an A, which met our investor expectations. Corporate responsibility is what we are very proud of. Starting with citizenship, we were the award winners for all 7 years in a row, starting in year 14. Our dollar amounts that we started out with, the high was $17,791, and the average was $3,937. By the end of year 20, we had contributed $103,588 compared to the average of $14,573. The average cost of per unit sold for the shoes to cover this, beginning in year 11, was $2.24, and at the end it was $3.20. We figured this was a good trade-off for being responsible for the areas that were hosting our company. We took our corporate responsibility seriously for our internal stakeholders. On pay and compensation, we offered and gave above average wages. Also, everybody received incentive pay for shoes that had no discrepancies. We also gave out annual pay raises anywhere from 5 to 10% a year. We also offered and gave competitive benefits for our employees. For the training and facility, we conducted best practices training. We also practiced safety training also. For facilities, we provided on-site child care facilities so that parents did not have to rush off to check on their children. We also offered safer workplace practices, and also, as an added bonus, we also offered in-facility cafeterias. For initiatives that we implemented and used, recycling is the first one. Anything that could be recycled, we did. We have green on our mind. Also, we used recycled packaging in boxes and also packaging materials such as packing. We also gave up to 9% of our profit to charitable contributions, and in the coming years we have the intention to raise it up to 10%. Also, we required that all of our suppliers follow a code of conduct like we were for their employees. If we were to continue with this ESG, one of the things that we would have continued to do would be energy conservation. We would have made sure that all of our lights were energy saving along with all of our machinery. Health benefits would also be another thing that we would continue to do. We would also bring the other two facilities, the European and the Latin American facilities, to full production to completely eliminate any tariff costs. Also, we would continue to use local suppliers. We would also avoid shipping out of the manufacturing area that we were in to avoid and reduce the tariff costs that I mentioned a minute ago. We would also continue to bring warehouse and manufacturing costs down by increasing our facilities. It spread out the cost, the fixed cost, therefore lowering manufacturing and warehousing costs. We would also continue with celebrity endorsements. We feel that they help get our name out there and made customers want our product more. We also would continue with our corporate and high citizenship practices. I feel that given to the community in the way that we have done in the past will continue to foster good relationships with the host country and the host cities. And now lesson learned. One of the lessons that we learned, which was extremely important, was to check the status of our decisions every day. We had learned that decisions made by other companies affected our members, so we had to adjust accordingly, which gave us flexibility in our strategy. Also, we found to become more profitable, we gave wage increases yearly. We also experimented with the numbers to find good combinations that would give us the most return. We would discuss strategies with each other to figure out what would be the best thing to do. Also, we would take out loans for the buildings that we had made or had erected, and also for the machinery with short-term loans, because we didn't want to pay as much interest. That would be a waste of money. Also, we found that we had to be aggressive in our pricing strategy and also in our compensation. By having lower prices on our private branding, we could sell more of it and therefore make more money. Also, we only purchased new equipment for our facilities. We felt that we had to do this in order to keep a high quality rating for our products. And on behalf of Aaron, Landon, and myself, we thank you for your time.